An important aspect of stock investing or trading is risk management. There are a few ways that we can use options to protect our stocks from market crash. First, buying a put option. Buying a put option is the most direct way to protect our stock from market crash. When buying a put option, we'll be protected if the stock price drops below the strike price. Let us look at an example. This is the Apple option listing for expiration date December 17, 2021 as of December 4, 2021. The current stock price is $161.84. So to protect our stock from market crash, we can buy a $160 strike price put option by paying a premium of $350. Remember, an option contract have 100 shares of stocks. This is the profit and loss chart of the trade. As we can see here, the trade is break even at $165.34, which is $161.84 plus $3.50 of the premium we pay for the put option. In return, we are protected from the huge stock price drop. The maximum loss is capped at $534 when the stock price dropped below $160 when the option expired, because we have the right to sell the stock price at $160 strike price with the put option that we own. As a result, the total loss that we suffer is limited to $534, which is $350 plus $180, even if the Apple stock price dropped to $100 when the option expired at December 17, 2021. Without the put option, we will have suffered total loss of $6,184 if the stock price dropped to $100. However, if the stock price does not drop below $160, we will suffer additional loss with the $350 that we pay for the put option. Let's say the stock price drops to $161. Our overall loss will be $434. However, if without paying for the put option, our loss is only $84. As we can see from the example, we will have an unlimited protection by buying a put option. Unfortunately, buying put option is also the most expensive way to protect the stock from market crash. When using the strategy, it is best to buy the put option before the stock price drops, because once the stock price drops, the option price will increase because of the volatility increases. The second way to protect our stock is buying a vertical put option spread. Let's go back to our Apple stock example. In this strategy, besides buying a put option at $160 strike price, we will also sell a put option at $155 strike price. The reason to sell the put option is to reduce the premium we pay for the put option. We can choose any strike price that we think the stock price will not drop down to when the option expires. In this example, we choose $155 just for the convenience as an example. The premium we pay for the vertical put option spread is $156, which is $350 that we pay for the $160 strike price put option we buy, minus $194 that we collect for the $155 strike price put option that we sell. This is the profit and loss chart of the trade. Buying a vertical put option spread will help us reduce the loss when the stock price drops within the spread of our trade, which is $160 to $155. The strategy only provides a limited protection. If the stock price dropped to $150 when it expired, our loss is $840 instead of $534 when compared to buying the put option strategy. As we can see from the example, we only have a limited protection by buying a vertical put option spread. However, the vertical put option spread is cheaper than just buying the put option. Same as buying a put option, it is best to buy a vertical put option spread before the stock price drops. But it can be used after the stock price drops because the vertical put option spread price will not increase as much with the volatility increase. The third way to protect our stock is selling a call option. In this strategy, we will sell a call option with a strike price that is higher than the current stock price, or the price that we pay for the stock if it is higher than the current stock price. Let's go back to our Apple stock example again. In this example, assume the stock price we pay is the current stock price, which is $161.84. The big question is what strike price of call option that we want to sell. There are many ways to determine what strike price to choose, like using the probability of expired out of the money, resistance level from technical analysis, stock value from fundamental analysis, and etc. When we sell call option to protect our stock from market crash, we may want to sell the call option with the strike price closest to current stock price to maximize the premium that we collect. In this example, call option at $165 strike price is chosen for the convenient example. We are collecting $261 premium from the call option that we sell. This is a profit and loss chart of the trade. The call option selling premium help reduce our cost of buying the stock from $161.84 to $159.23. However, selling the call option also set the maximum profit we can earn to $577 if the price going up beyond our call option strike price. Sell a call option only have a limited protection, as the maximum protection we can get is the premium we collect from selling the call option. Selling a call option also limit the maximum profit that we can earn from owning the stock. The strategy also best to be used before the stock price drop, as the drop of the stock price will also reduce the call option premium. The strategy also allows us to make extra profit if the stock price just moving sideways. The last method to protect our stock price from the market crash that I will discuss in this video is selling a vertical call option spread. In this strategy, we will sell a call option and buy a call option with higher strike price. Using our Apple stock example again, in this strategy, we will sell a call option at $165 strike price and then buy a call option at $170 strike price, collecting $137 premium. This is a profit and loss chart of the selling vertical call option spread trade. The vertical call option spread selling premium help reduce our cost of buying the stock from $161.84 to $160.47. Selling the vertical call option spread will reduce our maximum profit we can earn by $363 if the stock price going up beyond $170 strike price call option that we buy. We will make extra profit if the stock price stay below the break-even of the vertical call option spread that we sell, which is $166.37. Similar to selling a call option, selling a vertical call option spread only have a limited protection, as the maximum protection we can get is the premium we collect from selling the vertical call option spread, which is lower than just selling a call option. Selling a vertical call option spread will only reduce the maximum profit that we can earn from owning the stock. The strategy also best to be used before the price drop, as the drop of the stock price will also reduce the call option premium. The strategy also allows us to make extra profit if the stock price just moving sideways. These are the 4 basic option strategies that we can use to help protect our stocks against the market crash. Each strategy has its own pro and con. You should carefully understand each of them before using the strategy. Thank you for watching. If you think the video helped you, please click like and subscribe the channel.